welcome again, Ken Frier, our Chief Investment Officer, to this conversation. Today, we're going to be talking about principal protected notes. I, in the last 20 years, probably get on average 2 or 3 prospecti for principal protected notes a week. And we're going to talk about exactly what a principal protected note is and why, in our opinion, it makes absolutely no sense for an individual investor to invest in. And by the way, I've seen very sophisticated investors, according to themselves, buy principal protected notes. And I just think there's a general lack of understanding as to how they actually work and the building blocks that go into creating a principal protected note. So Ken, having said all that, maybe you could talk a little bit about what exactly a principal protected note is, or a PPN as we're calling it here for short. And then we can talk a little bit more about their appropriateness after we understand exactly what they are. So,
all right. So a principal protected note is protected in that you're unlikely to lose your investment, your principal in the investment. It's structured like a bond, like you're investing in the bond of a bank. But instead of getting a normal interest payment from the bank, you get a return that is contingent upon the return of another security. Often it's the S&P 500 index. So the kind of pitch that our clients would get was something like, hey, you could invest in this security issued by Bank of America. There's no chance that you're going to lose any money. And if the S&P goes up, then you could participate as much as 100% in the gains of the S&P 500 from the time that you bought the note. So on the surface, it sounds like, well, that's a pretty good idea. I couldn't lose money and I could make as much as the S&P 500 makes during the time I own the note. So that's usually the clients that come to us and say, well, should I buy this? It looks pretty good. There's some things that they need to understand about the structure that we'll try to explain here.
so examples of a PPN very specifically. And by the way, I mean, I'm going to call them, they're called principal protected notes, but they're also structured notes. And I've seen all kinds of them. I've seen the structured notes where the client makes money if the market goes down, the client makes money if the market goes up, the client makes money. Usually what happens is that the market has to go up more than a certain amount before the client starts to make money. And in some cases, the amount of money that the client makes would be capped at, a certain percent gain. But there's all different kinds of ways to construct these. And me, just as a registered investment advisor with an understanding of how to price and purchase options, as well as how to invest, money in treasury bonds, the ingredients to create a principal protected note are widely available. But why don't you just go through a quick example of what a typical principal protected note might look like and add a little more context to what we're talking about?
Yep. Why don't we pull up that chart, the payout chart for one of the principal protected notes that our client of ours was looking at recently. So in this possible deal, you invest $1,000 per note, and the payout is relatively complex. It's a 5-year note, but if the S&P 500 rises in the first year, then it becomes a 1-year note, and you get paid $1,075, so 7.5% rate of return in the first year. If the S&P 500 went down in the first year, then you hold the note for 4 more years. At the end of the 5-year period, so 4 years after the first year, if the S&P 500 has gone down, then you only get your principal back, the $1,000. If the S&P 500 has gone up, then you would receive your principal, the $1,000 plus whatever percentage that the S&P went up. So if the S&P was up 30%, then you'll get $1,300 at the end. So this is a really complicated structure to price. You need to be someone like John or myself that understands derivatives in order to figure out how to price this structure where there's two contingent payoffs, and there's also, it's a loan to a bank. And so the loan to the bank has value. That is, there should be, in lieu of getting interest from the bank, you're getting this complex payoff. So to figure out whether this complex payoff is better or worse than the interest that you would get from the bank requires some sophistication.
Yeah. And in general, I mean, I can generalize how these work in that you invest $1,000 and ordinarily that $1,000 over a year's time would generate, let's call it 6% in interest, right? And so there's, in that $1,000 investment, there's basically $60 to play with in order to purchase
$60 a year.
yeah, $60 a year in order to play around with and purchase. You could buy call options and you could sell call options that are farther out of the money. That looks like kind of what's happening in year one here. You would basically purchase a call option that would be struck at the money, and then you would partially fund the purchase of that call option by selling a call option that is 7.5% out of the money, right? That gives you the note maturity where you basically are receiving $1,075 at the first year. And then it would just be a matter of continuing to purchase and sell derivatives in the years following that based on what happens in the first year. So
Banks love to sell these things because you pay $1,000 for the note, and it typically isn't worth $1,000. If you buy the note, you'll get some offering documents, and it could be 50, 60 pages of fine print. In the offering document, it will say somewhere that the price you pay is probably more than what the bond is really worth. But few people really read through the fine print or really kind of have the background to understand specifically the kind of hidden messages in there. In this particular one, we highlight a sentence from the prospectus, which says that the bank currently expects that the estimated value of the note on the pricing date will be at least $850 per note, which will be less than the issue price.
yeah.
So if it was worth $850, you absolutely shouldn't buy it, right? Because you're paying $1,000 per note.
Yeah, you're basically paying 15% upfront for underlying economic interest that you could go out to the market and spend $850 creating yourself if you knew what you were doing. That's the gist of it.
We did the kind of stochastic calculation of the different outcomes and their probabilities. We actually concluded it wasn't quite as bad a ripoff as that it was worth maybe about $950 per $1,000 face, but you're still getting you're kind of putting an extra $5 in the pocket of the bank and the broker if you enter into this transaction.
Yeah. And so let's talk about some of the other drawbacks to principal protected notes.
Well, there were a number of issuers of principal protected notes before the global financial crisis. And then it turned out that, a few banks like Lehman Brothers went bankrupt during the global financial crisis. And so a note, which when it was sold as being, principal protected, you can't lose your money. It actually wasn't protected, and it became, part of the Lehman Brothers bankruptcy process. So it's rare that major banks fail, the issues of these, but you should recognize that you do have some default risk from the issuer of the note.
Yeah. And when I'm offered these on a weekly basis, and I try to block the senders of these notes as quickly as I can so they stop jamming up my inbox. But very few people are even beginning to consider what the credit risk is based on the issuing institution, right? They're just looking solely at the mechanics of the note and how it pays out. So,
and then the other thing that can happen is even if the issuer doesn't go bankrupt, from time to time there can be, a scare in the banking system. We had a scare last year when Silicon Valley Bank failed. Briefly the cost of debt of banks spiked. And if you own a debt security of a bank like a PPN, then the price of your PPN would fall. So another drawback is that these are not liquid instruments. If you wanted to get out, if you were worried about the credit quality of the issuer, you would have a hard time finding a good price for it.
Yeah. I mean, you could probably get out, but it would be at a significant discount to what your $1,000 was theoretically worth, or 950, I guess, as we priced it. So,
Mhm.
what about taxes? What's your take
So
on?
another issue that affects taxable investors is that even though in the principal protected note, you're not actually receiving any interest on the security, you're just waiting. In most cases, you're waiting for 5 years to see what you'll get. Did the underlying security go up? However, under the tax rules, you have to treat it as if you are receiving interest using these original issue discount rules. Because, so for instance, if this is the bank would normally pay 6% per year on a bond like this, then under taxation rules, you'd have to declare that you were receiving, that much income, the $60 per note, even though you weren't actually getting it, and you'd have to pay tax on that. So if you look at your sequence of cash flows on the security, you would end up with some negative cash flows, paying tax on interest you didn't get, which makes it, less attractive for taxable investors.
Yeah. And what about, do you have any comment on the regulatory environment surrounding PPNs, and are there
I
any
think that,
recent developments? Yeah.
yeah, I mean, I think I can speak for Jono and myself here in that the, the regulatory approach to protecting individual investors is often disappointing. It seems like politically in Washington, there's just more political power from the banks and the brokers than political power of individual investors. There are documents on these regulatory websites like Securities and Exchange about PPNs, but it doesn't really help you understand, whether it's a good deal or not. We think that as we're trying to convey here, the most important thing with this and really any kind of complex financial transaction is to understand whether the price that's being offered is a good price. And the regulations as they stand, they don't require the issuer to really give you a clear understanding of what the fair value is. You might get a warning like the one we discussed, which says that, hey, this might be only worth $850 for every 1,000 of face, but you really won't be told clearly, precisely that this is, you're paying this, but it's really worth that.
Yeah. And I think, and I might be mistaken here, as a registered investment advisor, we have a fiduciary duty. The bank that's selling this, they have a different standard. I think it's the suitability duty, which means that they only have to look at this in isolation, not necessarily in the context of a client's overall portfolio, which we do. So it's funny. I mean, I don't think that it's broadly understood in the registered investment advisory community that these, I don't think, at least in my opinion, don't qualify as meeting the fiduciary standard on behalf of clients. So I don't know, honestly, as I sit here and think about it, I don't know how they are able to sell these into the registered investment advisor segment. Or more accurately, I don't know how registered investment advisors are able to buy these given that they have a fiduciary standard on behalf of their clients. Because as you said, it's this ex ante, ex post. It's very entirely possible you could look at a principal protected note and it will do great with the benefit of hindsight. But as we stand here today and we looked at the ex ante returns, as we call them, and what the expected returns are for these instruments, they're universally bad. So I think that sort of summarizes the issue from a regulatory standpoint. Okay, so recap on this. Obviously, you're overpaying your $1,000 investment is actually worth closer to somewhere between $850 and $950. You have credit risk to the individual issuer bank. You have potential tax implications if you're a taxable investor, no liquidity, and and not a great regulatory environment. So I don't know. Can you think of anything good about principal protected notes? Yeah.
No, I think I'm aligned with you on advising individual investors to stay
Yeah.
away from these.
Yeah. Cool. Well, thanks for the time. Of course, you can visit atlasca.com, learn more about our products and offerings. And as always, follow the videos and subscribe to our YouTube channel. And you get these videos as soon as they're posted. Thanks.